Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and recently a client of mine asked me what REITs would you buy if you had to hold them for the next 10 years. I thought that this was an interesting question, as my selection would be very different if the market closed for the next decade and I had no option to exit my investments. This is really when Warren Buffett's advice to buy wonderful businesses at fair prices rather than fair businesses at wonderful prices start to make a lot of sense. To give you an example, you probably wouldn't want to buy a cheap office REIT if you knew that you had to hold it for the next decade, even if its valuation was discounted. On the contrary, you would probably prefer to buy a data center REIT or an industrial REIT with rapid growth prospects, even if you had to pay a premium valuation for it. It's a good reminder that over the long run, quality and growth typically matters a lot more than the yield and the valuation, as long as you don't grossly overpay, of course. So with that in mind, if I could buy just 3 REITs and had to hold them for the next decades, these would be my picks. Before I get started, I warn you, you might have never heard of the REITs that I will list in today's video. The first company that I would pick is SGRO plc, ticker symbol SGRO in the UK. This is one of the leading industrial REITs in Europe with a large portfolio of Class A urban last mile industrial properties located in high barrier to entry locations. SGRO, just like its peers in Europe, but also in the US, experienced a boom in demand following the pandemic, but this was then met with a lot of new development activity, which led to oversupply in 2024. This slowed down its growth and depressed its valuation, especially since this happened even as interest rates surged at the same time. As a result, SGRO is today trading at near a decade-low valuation, trading at 18 times FFO, an estimated 30% discount to its net asset value, and a 4.5% dividend yield, near the highest level in a decade. But the good news is that conditions are now finally starting to improve. Its occupancy rate has stabilized, rents have returned to growth, and so has its NAV per share. The REIT has a large mark to market in its leases on which it will capitalize over the coming years, as many of its leases expire and the REIT is able to bump up rents to market levels. Moreover, it also has many development projects on the way which will be delivered over the coming years and expand its cash flow, and the REIT has a solid balance sheet to keep acquiring new properties and more land to start new development projects, earning large positive spreads. Therefore, we think that SGRO is an attractive investment opportunity simply based on the industrial side of its business. But importantly, the REIT is now rapidly expanding into data centers. And this is really the primary reason why I'm including the REIT on today's list. Just recently, it formed a new major joint venture with a data center developer. SGRO is going to contribute a lot of land to it and end up owning an interest in a major data center portfolio. They expect to earn high returns relative to the cost of capital, and therefore this should nicely expand their FFO and their NAV per share, creating a lot of value for shareholders. And I think that as they further expand into this space, this will eventually positively impact their market sentiment. Another REIT in the US that's called Iron Mountain, that primarily focuses on paper storage facilities, recently aggressively moved into data centers and has very positively impacted its market sentiment. I'll put a chart on the screen to show you that. SGRO is now replicating the same model, but the difference is that its legacy industrial portfolio is far more attractive than Iron Mountain's paper storage business in my opinion, and yet it's today priced at a steep discount relative to it. In both cases, the data center business is still relatively small, representing only about 10% of their revenue. But both are very well positioned to grow this data center business at a rapid pace over the coming years, given that they own a lot of undeveloped land on which they can now develop these data centers, and they have the skills and relationships needed. But again, the key difference here is that SGRO's industrial portfolio is far safer and better positioned for long-term growth than Iron Mountain's paper storage facilities in my opinion. This is not to say that paper storage is going away anytime soon, but it will inevitably face a long-term decline as the world continues to digitize. Moreover, in many cases, Iron Mountain does not actually own its own properties. Instead, it owns just the storage racks inside of them. Therefore, Iron Mountain should be priced at a discount relative to SGRO in my opinion, but it's the opposite today, which shows you just how cheap SGRO currently is. As the REIT now continues to expand into data centers and its growth accelerates, we expect its market sentiment to improve materially over the coming years, and this has the potential to result in 30 to 50% upside. And while we wait, we're earning a 4.5% dividend yield, and the REIT continues to grow at 6 to 8% per year, which on its own, the yield and the growth should result in double-digit total returns. And that is why we like this REIT so much, especially if there was no liquidity and we had to hold it for the next 10 years. It has great potential to create a lot of value over the long run, and yet it's today still priced at a very reasonable valuation. Hey, before going to the second REIT, can you please do me a huge favor and click the like button if you enjoy this type of content? It will help me a lot to keep on growing. Thanks so much in advance. My second pick will be Storage Vault, ticker symbol SVI in Canada. This is the leading Canadian self-storage REIT. Today we have the benefit of hindsight to know that American self-storage REITs have been exceptionally rewarding over the past 30 years, earning about 18% average annual total returns. It was the most rewarding of all property sectors because the demand for self-storage was growing at a rapid pace, and these REITs had the opportunity to develop new properties, earning exceptionally high spreads over the cost of capital. At the same time, they could buy properties from smaller, less sophisticated landlords, change their brands, implement revenue optimization models, and include them in their national advertising campaigns to rapidly boost their cash flow and create a lot of value. And I think that Canadian self-storage REITs are set to replicate similar strong returns over the coming decades because they are today still about 20 years behind, with far less self-storage space per capita in Canada than in the US. And you don't have to take my word for it here. Storage Vault is the leader in Canada and it has earned a 10x to its investors over the past decade. It's been so exceptionally rewarding as it's been capitalizing on this undersupply by building new properties, earning large spreads of its cost of capital. And given that today there is still about 3 to 4 times storage space per capita in Canada than in the US, we expect these exceptional results to continue for a long time to come. Despite that, Storage Vault is today priced at a very reasonable valuation. It's actually trading at a discount relative to most of its American peers like Public Storage, Extra Space Storage, despite those facing much more competition and slower long-term growth prospects. I think that one of the reasons why so few investors are interested in investing in Storage Vault is because dividend yield is very low at just about 0.2%, but that's intentional. The REIT has such great reinvestment opportunities that it prefers to retain nearly all of its cash flow in-house to reinvest organically in growth, and I'm all for it given how great this opportunity is. Over the next 10 years, I expect this REIT to create a lot of value, and therefore I wouldn't mind if the market closed for the next decade. By the way, we invest in lots of other Canadian REITs at High Yield Landlord, and if you want to access our full international REIT portfolio, which includes REITs in Europe, in Canada, in Latin America, in Australia, in Asia, even one in Africa, you can join us for a 2-week free trial. It will be the first link in the description of this video. The final pick for today's video is International Workplace Group, ticker symbol IWG. IWG is not officially structured as a REIT, but it's what we like to call a REIT adjacent business in that it is a real estate company that shares many REIT characteristics. It's the biggest co-working company in the world, much bigger even than WeWork. And I think it's going to be a huge winner in the AI revolution, which I expect to transform the office landscape. It's going to lead to significant white-collar labor force disruption. Companies know this, and therefore today they are very reluctant to sign long-term leases of 10 to 15 years like they used to in the past. They simply don't know how many employees they will need in just a few years from now as AI models keep on improving, and therefore they are now requesting more and more flexible office terms. And EWG happens to be the clear leader in this space. Therefore, I expect a growing number of landlords now to turn to EWG to strike partnerships and have it manage the flexible office components of their buildings. And this is truly a huge opportunity. I'll put a slide on the screen that compares EWG in a way to what Uber is for transportation, what Airbnb is for hospitality. EWG is now solving similar issues for the office sector. The company is now doubling down on growth by greatly increasing the size of its sales team, and they've recently guided to reach about 1 billion of EBITDA by 2029. I think that if they come even close to that, the share price will be a lot higher than what it is currently, and therefore I'm very happy to hold a large position in EWG. This is actually our single largest investment at High Yield Landlord, currently representing about 13% of our core portfolio. We of course invest in it at quite a bit lower levels. We got to buy shares as low as about 150 British pence per share. Today it's at closer to 250, but even at this level we think that this remains a very attractive opportunity given that it's the leader of a sector that's going through a transformation that's going to be a major tailwind for the company. I think that the value creation will be huge by 2029, let alone a decade from now, and therefore this is one of those companies that I expect to hold for the next decade. Once more, if you want to access my full real money REIT portfolio, you can join us at High Yield Landlord for a 2-week free trial. You won't be charged anything the first 14 days. You can sign up, review our research, our portfolio. If it's not for you, you can cancel in just a few clicks, no questions asked, and you won't be charged a penny. It will be the first link in the description of this video. Now let me know in the comment section below what REITs you would buy if you had to hold them for the next decade. I'm very curious to know what would be your picks. Once more, if you could click the like button, subscribe to your channel, helps me a lot. Thank you. See you at my next one. Bye bye.